Good afternoon, ladies and gentlemen. I hope you can see me. I hope you can also hear me. If you can, that would be great. Just let us know. It always helps to make sure that we're actually going out properly to the world. And thank you for joining us here for this afternoon's Admirals Trading Spotlight webinar, where we're going to talk today about how to improve your trade entries. That's a fascinating subject and something that we could talk about for for the next week or so. For the next week or so, quite easily, and lots of traders will have lots of different opinions on what would kind of be defined as an improved trade entry. But you will find out more about that in a moment. But as I said, if you're joining us here today on the Zoom call, that's fantastic. It's great, fantastic to hear where you are from, because I appreciate that we always have a wide range of experience in the room. Okay, from complete beginners to very advanced traders, and you're all very welcome here with us this afternoon. If you're watching this on YouTube, okay, later on demand, that's fantastic. Please, if you like the webinar, give us a like. Okay, be sure to subscribe to the Admirals YouTube channel, and if you've got any thoughts or comments on what we talk about here today, please put them into the comments box, or if you've got even any suggestions or ideas that you'd like to see us cover in the future, by all means put them either here in the chat box or invariably on the YouTube comments list. So as I said, you're all very welcome. It's great to have you here with me. We appreciate that it's been a rather fascinating last year, okay, and that people have been making the best of it. And we here at Admirals hope you're all safe and sound and healthy wherever you're joining us from in the world, and that we hope that you're getting back to some element of normality in your lives. And so we appreciate that. It'd be great for you here to join us with us here today. So if you'll just bear with us a moment, what I'll do is I'll bring up the sort of slides, and we'll actually look to sort of begin our session today. So I'm just, as I said, hopefully I'm hoping that there we go. There we go. I'm hoping that you can all still hear me. I hope you can all still see me. I hope you can actually see the slides as well. Jacek, it's fantastic. Great to have here. Okay, Opera, thanks very much. Great to have you. Great to have you all here there with us. As my wonderful assistant Anna has just put there in the chat box, if you've got questions or if you've got even thoughts or considerations, please by all means drop them into the chat box or put them into those YouTube comments, okay, that are down underneath when you're watching this later. But as I said, what we're going to talk about today is how to improve your trade entries. Fascinating subject, okay. Most traders will have an interest in this, and I'm hoping that by the end of this session that you'll actually have a little bit more insight, a little bit more of an idea how to do it. And what we'll also do is, with the time allowed, we will hopefully switch across to the Admirals MetaTrader platform and have a little look at a couple of them in let's say in live in a kind of live market environment. Appreciate people always like that, so be sure to stay with us to the end to see how it kind of gets applied into the live markets. But as the title says there, what are the pros and cons of using advanced entries? And as I said, it would be fantastic to hear what, if any, experience you have of improving your trade entries. Okay, as I said, I appreciate we have a wide range of experience in the audience, and for new traders that that may not actually be aware of, actually sort of understand what we're going to talk about today. Well, hopefully you're going to be educated. For those of you who've got a little bit of trading experience, join us. Well, hopefully this will just give you a little bit of an idea, some bit of food for thought, maybe something that you already do, maybe it's something that you sort of kind of not really considered before, maybe it's completely new to you. So hopefully it'll be something that you can take away and start to look at and utilize in your own trading business. But as I said, if you've got any thoughts or considerations on how you improve your trade entries, or what you may do, or what if any experience you might have, please by all means put that in the chat box or in the commentary box, and we're fascinated to hear what your own experience is. As always, ladies and gentlemen, what you will have seen, hopefully, is over the last month or so, is that Admiral Markets has been rebranded towards Admirals as part of the kind of 20th anniversary celebrations. It really doesn't really make any particular difference to you as a client of Admirals. You still get the sort of kind of great products, the great service, and the great resources. It's just so that you're aware of the kind of the branding exercise that we are taking ourselves through. And as it says there, Admirals is, they're a Forex and CFD broker with a wide range of instruments that have a global presence with local language support. They're licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products and allowing you to engage with markets using either MT4, MT5, or also the actual Admirals Supreme plugin, which is a useful bit of kit for traders. If you have any questions about Admirals, please feel free to get in touch with your account representative and they'll be very happy to help you and guide you. So what are we going to talk about today? Well, as I said, we're going to talk about trade entries. And firstly, you might say, well, why would you actually want to improve your entries? All right, maybe you're quite happy with what you've been doing at the moment, and that's not there's no problem with that. But I'm going to explain maybe a little bit an insight into maybe why you'd want to look at improving your entries. I'm going to talk a little bit about the options, and there are many options, but we're going to kind of focus on one particular one today because we have the limits of time here upon us. We'll talk as we go through about what are the pros and cons. Those of you who've joined me for previous sessions will know. I'm always very clear that there is no such thing as perfection. Okay, there's no such thing as perfection. If anyone tells you there is, they're talking nonsense. All right, but what it is about is understanding the pros and cons, so that you can make a educated decision, an educated choice about how you'd like to, employ these tactics in your own trading. And yeah, I'll show you a little bit about how we use them in our own trading. And by that, that's actually, in a bit of my own trading as well. So for those of you who don't know me, my name is Paul. A kind of various background. I've traded for many years. I've traded for institutions, okay, and coached clients as well. Coached lots of traders over the years. Primarily, I like to trade FX indices and commodities, and for a longer term trading, for my kind of swing and position trading, I tend to be a trend trader, and I tend to be a mean reversion and a reversal trader for intraday trading, which you might get a snip or a hint of today as we could look at the charts later. But let's talk about how to improve your trade entries. There you go. I'm rubbing my hands in glee because we're all traders, aren't we? All right, we're all traders, and actually all traders love seeing other types of entries. We all like to see setups. We all like to see particular tactics. We all like to see other entries, anything that might be kind of help us improve our edge. Okay, and as traders, we're trying to gain edge, or we're trying to improve edge, and that in itself is a webinar all of its own, and maybe that's something we'll look at for the kind of recent future. But there's many different ways that you can effectively improve your trading edge, from technical ones like what we're going to talk about today to behavioral ones, which kind of come under the sort of kind of more looking at the kind of psychology of trading. And as I said, maybe that's something we'll look at in the near future. What I tend to find is that completely new traders, and I appreciate that will make up a good deal of the people here with us today. New traders are they're happy to find an entry for the trade, right? And any entry is better than no entry for a new trader, because very often new traders they will trade everything. They want to trade anything because they want to be in the market. Okay, they want to have that experience of placing trades, of buying and selling, okay, in the market, and having exposure and experience to it. And as this slide says, that's all well and good to begin with, ladies and gentlemen, right? So, but however, many traders, as you develop in your experience, okay, they're looking for ways to improve their trade entries. Anything that can just help them, okay, anything help them just sort of, nudge the kind of either the success rate or the profitability of their trades, okay, or the positive expectancy of their trades, just nudge it in their favor a little bit more. And what we're going to talk about today is I'm just going to share with you, one style of improved entry that traders can take away from today and use in your own trading, and in particular that using things like price action reversal candlesticks. And what you'll see is that part of the pieces we'll talk about today kind of builds onto lots of the webinars that I've delivered here with Admirals over the last year or so. Okay, so the kind of the piece, think of it as like pieces of jigsaw puzzles that are all coming together that actually help you sort of just improve slowly but surely in your own way of trading markets. So, as I said, the first question is, well, why would traders want to improve their entries? Now, that might seem kind of clearly obvious that, always traders would want to, but not always, because there's all sorts of different types of traders in the market. And some traders, who are, let's say, fear-based traders, if they've found a particular groove or a way to operate in the market, they're invariably very, very happy and very clear with it and will not want to change. Whereas others, some of us will actually want to sort of see, what can we do to improve our business? It is our business. And like any business, you're kind of always looking at ways, how can I reduce my mistakes and how can I increase my profit margins? That doesn't really matter whether you're trading financial markets or you're selling fruit and veg on a market stall, okay, or you're selling Apple phones, etc. Okay, any kind of business, you want to reduce your kind of mistakes, okay, reduce your overheads and increase your profit margins, and trading as a business is no different. Well, in terms of looking at how to improve a trade entry, the payoff is it's all to do with managing your risk to reward ratios. That's how I would look at it. Okay, others may differ, but for the purposes today, I would look at it. It's all about us managing our risk to reward ratios. Okay, which for the rest of this particular session, for just to make it easy, you'll hear me call that R3. Okay, your risk to reward ratio. Okay, so for whatever I'm going to risk, I want to be able to improve the reward. Those of you who have joined me for many of the sessions over the last year, 18 months, will know I'm always really keen on having an asymmetric reward to risk ratio. Okay, if I'm risking 100 euros, I want to be able to sort of generate 200, 300, 400, 500 euros. Okay, asymmetric reward to risk. Lots of other traders will do it the opposite way. They'll want to, they'll risk 100 euros to make 50 euros. And that would be their way of operating. It isn't mine. It's not a way that I would suggest. Okay, I'm always looking for asymmetric reward to risk ratios. So by improving our entries, we may well be able to improve our R3 numbers, which is what we're going to talk about for the remainder of the session. But I appreciate we have all sorts of experience in the room, so I just want to give a little bit of a background, a little bit of understanding to help people grasp. I appreciate, as I said, that I've been trading for many years, okay, but lots of people have been only trading here, joining us today for maybe only a few weeks. So, I'm just trying to go through and give you a little bit of explanation, understanding, so that you're fully equipped to understand the concepts that we're going to talk about and what I'm going to share with you today. So firstly, to help us, let's understand trade risk. And this would be my definition of trade risk. As I said, other people may have different definition. But for me, when I think of trade risk, when someone talks about trade risk, that what I'm thinking of is it's the number of, whether it be pips, points, ticks, okay, regardless of what kind of instrument you're trading, it's the number of those pips, points, ticks that between your entry and your stop loss. So let me bring up the old drawing tool here. Okay. So, here we've got, there's a bullish engulfing candle here. Okay. And it's a case of what I want to know is I want to work out, the kind of, as I say, the number of pips, points, ticks, depending upon what instrument, it might be different for, if you're trading this on euro dollar, as opposed to trading this on a particular stock, as opposed to trading this on, let's say, the S&P. But really what we're looking for is, what are those numbers, those points between my entry, okay, the price that I'll be getting into the market and my stop loss, okay, which is basically it's kind of this distance here, okay, and depending upon what instrument you're trading, depending upon what time frame you're trading, that number will be different. But what you will always hear me and other traders talk about is that kind of distance, okay, that number of pips, that is always defined as 1 unit of risk, okay, or 1R. All right, so when you hear me or other traders talking about the risk 1R, or they invariably what it is it's just a way of describing that particular distance. Why would we do that? Well, I know personally for me, what that does is when I'm just talking in terms of units of R, okay, it takes out of emotions, okay, but you're not thinking in numbers of pips, you're not thinking in number of pounds, you're not thinking of anything like that. It is just 1 unit of risk, 1R, okay, that's it. And as a trader, as I said, I'm always looking to earn multiples of R. So, whether this is 50 pips, all right, okay, 50 pips or 6 ticks on the S&P, okay, or points on points in stocks, etc. It's just it's 1 unit of R. And so what I'm always looking to do is try and earn multiples of R. So if I'm risking 1R, I'm always looking to, can I be generating 2R, 3R, 4R, 5R in return? Okay, that's that asymmetric reward to risk. That is the way I like to trade, and it's the way I suggest people to trade. But I appreciate that, you know, people have their own ways of wanting to do it. But what I just want to be able to do is to, you know, define how I think of as trade risk. Okay, this is not capital risk. Okay, this is not capital risk. This isn't defined about, you know, the size of my trading account, or, you know, how much money I'm risking on a trader. You know, there's nothing about position sizing. It's just for the purposes of today, just focusing on trade risk. Okay, just to keep it a nice simple definition. And it's important that we understand trade risk. Okay, it is understand, because by doing so, it allows you to identify ways to improve our trade, you know, in terms of our to reduce our trade risk and allow us to effectively improve our overall R3 numbers. All right. So, you know, how can we improve our trade entries? Well, what we're going to do is we're going to start with like taking a look at something I call consistent targeting, and from that will develop out into how we actually sort of improve the trade entries. And I said I'm going to share with you one way that I do it myself today. Okay, there's lots of different ways you can do it, but hopefully I'm just going to share you a simple way that will work, that I utilize myself in my own trading, and hopefully that will give you an idea about how you could improve your trade entries, which would effectively reduce your trade risk, which would then invariably enable you to have a better reward to risk ratio, okay, for your particular trades. And as the session goes on, and as we go through the slides, hopefully that will play out, and you'll understand that a little bit better. So this is something I call consistent targeting, all right, which we'll understand why when I explain it. And the background is you know, I've mentioned in previous webinars, okay, you know, when you're taking a trade, most traders, you're either going to use a trailing stop, okay, or you're going to have a target for your particular trade. Part of trading is about knowing yourself and knowing what works for yourself. I'm an ex-Air Force guy. As an ex-Air Force guy, I always like to hit a target. All right, that's me. Okay, that is me knowing who I am. That's me knowing, you know, how I can operate. And the key in this word is consistent. Okay, I want to be able to trade in a way that I can just trade consistently, trade after trade after trade. Okay, it's not about the setup or the outcome of one trade. It's about the outcomes of 20 trades, 50 trades, 100 trades. Okay, that's where it is about building that sample size. And I'm going to show you, you know, a couple of simple tools, okay, that I use to help me find my consistent targets, all right, and also help me increase the reward to risk on my trades, okay, and that's what we'll take a look at. So, and this is where I use this is where I would use Fibonacci, all right, and also the tools of MT4 and also MT5. Okay, remember Admirals will provide access to both, and they're both pretty much similar on the tools on the platforms. And what it does is it allows me to identify and set my targeting. But, and what's most importantly for us today, is to also identify, you know, what I would call maybe my aggressive improved entry, because that's what we're here to talk about today. We can talk about, you know, different types of targeting in future sessions. We can actually talk about different places to sort of put your stop loss. You know, we can talk about those all day. But today we're just going to focus. On entries. Okay, that's what we want to do. And this is where, you know, I use a pullback within my trigger candlestick to enact an entry that provides an improved reward to risk ratio for myself, that R3 number. So let me start to explain it further and show it and share it with you. So I'm not going to read out this slide. My suggestion to you, if you're using it, for example, on MT4, I would say, you know, I would hit your screenshot or screen capture piece on your thing, because actually what it does is that is effectively a way to sort of amend the Fibonacci tool on MT4 that will just allow you to set it up for what we're actually going to talk about here today. So let me just pull this out of the way and give up the what it allows you to do. Okay, and hopefully you can, as I said, you don't need to read. My suggestion is just take a screenshot of this. Bosh, take a screenshot, because what it does is it shows us that, you know, when I basically put on my Fibonacci tool, drawing tool on a candle or on a zone, what it allows me to do, okay, is it effectively allows me, rather than the basic tool just basically gives you the number, all right, just gives you the Fibonacci number. Well, by actually inputting those values there, okay, what it'll actually do is it'll bring up the actual number, okay, it'll bring up the actual level, and you can amend it to actually demonstrate whatever particular, whether it be Fibonacci retracement or Fibonacci extension, okay, whichever suits your particular requirements. Today, what we're going to be talking about is we're going to talk about just effectively 3, well, maybe 4 kind of these particular numbers, which we'll go in. But for this particular slide here at the moment, as I say, what I suggest is just take a screenshot of that so you can actually read that and do that if you're utilizing your MetaTrader platform. So how do I use it? How do I use this kind of Fibonacci tool, right? And what am I using it to actually do? Well, as always, the first way I'm going to use it is identify my stop loss, okay? Risk management comes first, okay? You can have all the sweetest entries in the world, but if your risk management is hopeless, it ain't going to matter, ladies and gentlemen, all right? So your first element is risk management. So I'm always going to be out looking to identify kind of where I'm going to place my stop loss. So as I said, that in itself is a session, a future session, okay, for just talking about stop loss placement. But for today, okay, what I'm talking about doing is, in this particular case here, I've identified a bearish engulfing candle I wish to short. And once I've sort of used the Fibonacci tool, and as I said, when we switch across to the charts in a few slides time, I'll show it live, is that, it basically provides where the top is. And I know my stop loss is always going to be just above the kind of the sort of the trigger candle, okay, the price action candlestick. My stop to begin with is always going to be just above that. And that might depend upon what time frame, okay, but on a kind of a daily chart, it might be kind of 10 pips. On a shorter time frame, it might be 2 to 3 pips. That will depend upon the kind of time frame I trade. But the idea is the stop loss is above, in this particular case, it's above the kind of the high of a candle I'm going short on, or beneath the low of a candle that I'll be using as a trigger to go long. And that's the kind of important thing. As I said, you never sort of don't fight that. Okay, always make sure you have a stop loss in place. And then what I might look to do is to understand the kind of identify my targets. Okay, remember what I said earlier? Some people are going to use a trailing stop. Some people are going to use a target. Okay, I like to use targets. Okay, there will be people here. There'll be people here who would argue that that actually it's better to trail stops. There'll be some people who would argue it's better to use targets. That's fine. As the key is in the name, consistent. Okay, consistent targeting, because actually it's just more about me being consistent every time. Okay, and I just find it easier. Just trade on, trade off. I don't have to really worry too much. Okay, I'm not trying to be a bit of a smart ass. Okay, I'm actually just basically getting on with the trade. And for me, okay, what I normally have is a kind of a first target, which is the 261 fib extension. Okay, of the candle that I'm using as my trigger, and then the other one I might use is the 423 extension. Okay, so those are, when I string that on, that's what I'm looking at as my first targets. But as the slide says that I will take notice of relevant support and resistance levels in there. Okay, or big round numbers, psychological levels. Okay, the old trading adage of "don't be a dick for a tick." Okay, is still implies. Okay, you don't escape that in any way, shape, or form. But as a general rule, I'm using kind of 261. Primarily 261 fib extension for when a shorter time frame, and the 423 fib extension for kind of swing trades. That's how I generally tend to work. There's more to it, for my own trading, but today I'm just sharing a very kind of simplistic version of it. And actually, what I'm particularly looking for, okay, and this is where we start to get particularly interested for us, is that what we're looking at is, how do I improve my entry? What is it that I'm looking for? Okay, so in most trades, once people identify the kind of the particular level, all right, this is a bearish engulfing candle, as I said right on. The stop is above the kind of above the high there, and most people would effectively be waiting to sort of trade the kind of the break. Okay, to be trading the kind of the break of that candle beneath. Okay, and that's perfectly acceptable. Okay, no problem with that at all. And if you're a new trader and you're looking to have simple precision on how you take a trade, that's absolutely fine, no bother at all. But today is about how I improve my trade entries, and what I particularly use. And what I particularly like to use is, and you can probably see it here, is that actually, once I've identified my kind of trigger candle, and we're going to talk about specific candles in a few slides time. well, then what I actually do is I identify my entry as a kind of a third of the way back into my trigger candle. All right, it's a third of the way there. That chart could get very scruffy there. So instead of, in this particular trade, instead of maybe getting in at like kind of 108.60, in this case, a third of the way back, my order will be placed at about 108.72. Okay, so it's a third of the way back in to the actual trigger candle. That's what I'm particularly looking for. I'm expecting price to retrace a little bit before it particularly drops. Okay, so very quickly, as soon as I use that Fibonacci tool on my, let's say, my candlestick, I know where my entry is, I know where my stop loss is, I know where my target is. Okay, I've got the data I need very quickly, very simply, and so I can actually effectively sandbox the trade. Okay, so because once I know where my entry is, I know where a stop loss is, well, then I can work out my position sizing. That is the capital risk element, but I'll also have an understanding of my trade risk. Okay, how many pips am I actually risking? What is the possibility of my kind of reward to risk based on using whether it be a 261 extension or a 423 target extension? Okay, in my trade, and that I like to keep things pretty pretty simple, pretty robust, pretty almost kind of mechanical, kind of see the trade, take the trade, manage the trade, exit the trade, debrief the trade, repeat the trade. It doesn't sound very exciting, but that's because pretty solid trading is quite like that. It is about trying to keep it as simple as possibly can. So as I said, okay, I tend to use the 261 fib extension for my income trade. So they're kind of intraday trading. We're using the kind of a standard stop loss, and as I say, that kind of the third pullback. And probably you can see what I showed you a little bit earlier, the kind of how you can amend the kind of settings in the Fibonacci tool on MetaTrader to be able to sort of write out what you need it to be to demonstrate that the levels. Okay, and you can probably see already I have it in there as a third. Okay, so I know the level, as I said, I know the level, I know where my stop's going to be. And I think this was a swing trade. I know where my target is going to be as well. Okay, but what I find is when I'm using that kind of third entry pullback, all right, and the kind of the third of the way back into the trade, well, and I'm using the standard stop loss. Okay, well then on my kind of shorter term trades, using the 261 extension as a target, well then I'm generating. It will differ a little bit, but as a rule of thumb, between about 1.8 to 2.3 R per trade. Okay, so it's asymmetric. Okay, it's an asymmetric reward to risk. That's what I'm always looking to try and do. Okay, I'm always trying to generate more. Okay, than I'm risking, because that to me is the smart savvy way to particularly trade. Whereas if I use the 423 extension, okay, as a fib extension as my target, well then when I'm using the standard stop loss, which we're covering today, and let's call it my third pullback entry, well then sometimes now my kind of reward to risk when that trade works out can be somewhere between just over about 3.2 R to around about 5.5 R. Okay, sometimes a little bit more, but as a rule of thumb, it can do that. Okay, and that is a very handsome. Okay, it's a very fantastic reward to risk. Okay, for me, and that's before you've actually even added to that trade, which once again is that's another topic of conversation for another day. But as I said, the important thing is that for a swing trade, once I've identified my trigger candle, I know where my stop loss is going. I know where my entry is. Okay, it's a third of the way the pullback. Okay, into the candle, and for a swing trade, I'm looking to sort of target the 423. Okay, fib extension of that candle. All right. Is this perfect? No, it's not. I said that earlier on, and I say it every week. There is no such thing as perfection, but it's consistent. Okay, it's consistent and it's simple. All right. I just I identify my candlestick entry, pull the Fibonacci tool over it, identify the third of the way pullback, identify where the stop loss is, identify where the target is, do my position sizing, and then basically the trade goes on. Okay, nice and simple. So as I said a kind of bit earlier on, this is the kind of way I'm looking to improve my trade entry But, you know, what I also recognize is just showing a couple of ways of many traders use price action candlesticks as their entry trigger. And there's lots of that basically, you know, we have covered before in a lot of the Admirals webinars, and you'll find them, you know, across the sort of the webinar archive on the YouTube channel or on the Facebook page. Okay, so, you know, if you want to know more about those specific types of candlesticks, then please, you know, you can go in there and you can gorge yourself on the masses of resources that we have there. But, you know, very popular candlesticks that you'll find used are things like rejection candles or pin bars, engulfing candles, key reversal candles, and morning and evening stars. Okay, today we're just going to focus on pin bars and engulfing candles, but the idea is the same for pretty much any kind of candlestick that you might be using as a trigger, okay, for your trade. That's what we're gonna focus on. And as you know, as it says there, you know, regardless of what I'm going to share here with about, you know, how to sort of improve your trade entries to improve your reward to risk ratio, that is not a get out of jail free card. All right, it doesn't allow you to avoid good trade selection. All right, that is paramount. Okay, that is always paramount. That should be part of your standard trading routines. And experienced traders know that it's when you trade these patterns that makes the difference. Okay, it's not about trading every single one of them. It's about the context. Okay, it's about where they appear. It's about that confluence of events. Okay, 2, 3, 4 things all coming together at one time, a place. And by improving your entry, okay, as we'll look a little bit more deeply, that's just merely helping you improve, okay, your R3, okay, your reward to risk ratios. And that's what we're always just trying to do, to, you know, as I said, to just nudge our expectancy in our particular favor. And so, you know, as I said, if you're not really entirely sure, you know, what we discuss or how we would like consider what is a confluence of events, well, ideally we want to see these reversal, you know, candlestick patterns, you know, happening on a pullback themselves at a level of support or resistance, okay, or a big round number, you know, as part of a trend. And, you know, when you have that confluence of events, when you've got 2 to 4 elements coming together in one time and place, well, that is when you're more likely to have, you know, a better trade selection. And why there is an element of subjectivity, because, of course, you know, you are waiting for these elements to occur, to come together, okay? And it doesn't matter whether, as I said, whether you're trading 30-minute charts or monthly charts, okay? It's waiting and identifying when these particular areas come together. So, you know, very quickly, as I said, I'm not going to go through all of the candlestick patterns in general, because there is a wealth of resources on the Admirals YouTube channel for you to basically engage with and enjoy. But most of you will know what a pin bar is, okay? A rejection candle, right? It must have its opening and close within the previous bar. The candle wick should be 2 to 3 times the length of the body, and you should have a kind of a long nose protruding from all of the other bars, okay? And you know, good pin bars, you know, will stick out and are very obvious. And when you look on charts, you'll find them, you know, you will find them all over the place, regardless of time frames or you know, or instruments, okay? You'll find them all over the place. And so most of you will have been taught like a standard entry, all right? A standard entry, which is, you know, it is effectively, you know, some of that is about a kind of risk profile, but in terms of the standard entry, okay, it is that normally once you've identified, you know, a pin bar, you know, let's say, you know, this has been, just move this here, you know, this has been in an uptrend and it's pulled back, okay, and you can see here it's bouncing off there the 20 period moving average. So, you know, we're in a trend, okay, we've pulled back, we've printed a pin bar at the 20 period moving average. You know, there's a confluence of events there. The standard way is that you would put, you know, for a long trade, is that, you know, you would have an entry order above to basically to buy the break of the high. So you're waiting for the next, in this, let's just call this a daily chart, for the next day when the price trades through that entry level. That is where effectively your entry of the market would be, you know, with your stop loss beneath the low of the pin bar. And that's a pretty standard, but it's perfectly acceptable, because actually if price just dumps and goes that way and trades through that level, well, your idea is wrong and you don't want to be part of that trade anymore. So that's the kind of the standard way probably most people are taught. That's the way most people operate. And let me say that there's nothing wrong in that, ladies and gentlemen, nothing wrong, okay? And if you're trading away happily with that, then fine, so be it, okay? But when we start to look at the improved entry, okay, which basically based upon what we covered a few slides before, is, you know, when we get in the improved entry, is instead of, you know, waiting for the price to effectively break through the high. Well, what we're doing is, we're having an entry now, on let's say on a daily or 4 hourly or weekly chart. That would be allow you to place a suitable order, okay, on the system. That is basically 33%, a third of the way back into the actual trigger candle, with your stop loss still in the same place. Okay, so it's it's a case of giving you just a different entry and stop loss, and it's what that will help you do is provide just a better particular entry. When you look at an engulfing candle, okay, for those of you who don't know, an engulfing candle, effectively the high and the low of the bar engulfs the range of the preceding bar, okay? That's what you're looking for. And as I said, I'm not going to go through how they particularly set up today, because there is a wealth of stuff on there, a wealth of resource on the Admirals website. Just a reminder, okay, engulfing candle, the high and the low of the bar engulf the range of the preceding bar. They tend to be less frequent, okay, than a pin bar, but they're also more powerful, okay, than a pin bar. And very often it will signal a significant change in trend and sentiment. And I'm talking about engulfing candles here, but this is equally applicable for key reversals, okay? There's a significant difference between engulfing candles and key reversal, but in terms of what we're looking at today, it's quite simple to how it sets up. So when we're trading an engulfing candle, and here we go here, price has been moving up, and then we can see here, okay, that price prints an engulfing candle because it entirely engulfs the candle beforehand. Well, normally what you're doing is, remember, is on a bearish engulfing candle, you're trading in the direction of the close. And once again, what you'd be waiting to do is you'd be waiting for the price to trade through the low, okay, through the low of that particular engulfing candle with your stop loss above. The challenge you might have with is that engulfing candle might be a very big candle, so invariably, the trade risk on it might be quite significant, which means that trying to achieve a really huge reward to risk might be difficult. And the standard safe way is effectively just being able to look for a 1-to-1 reward to risk ratio, okay, for standard entries on engulfing candles. And some people will be very happy to trade that will work for them. But what I want to share today is I wanted to share this kind of improved entry, okay, criteria, namely, whereby having identified it, okay, instead of waiting to be entering here, what we're actually doing is we're placing an order to short the candle a third of the way back into the trigger candle, okay, third of the way back in, just stringing our Fibonacci tool across it, identifying where the third of the way pullback is, and that is where your entry is. Your stop is in the same place above the high, but also now you're looking to target the kind of the 261 fib extension. So now you're actually, instead of a 1-to-1 reward to risk, now you're starting to push it towards about 1.5, okay, 1.5 to 1.8 reward to risk, depending upon the instrument, depending upon the time frame. But already, hopefully, you can see that just even if you just did that, you're just starting to nudge. Okay, you're nudging the kind of your R numbers. Okay, your profitability just in your direction. Okay, and that's what this is about. Okay, it's not about turning one overnight trade into just a stunning trade. It is about just trade after trade, just nudging the R in your favor. So here's a couple of examples. Okay, so this is it's a gold. Okay, this is the gold chart. Okay, it's daily chart here. Let's just get the old drawing tool here, and actually, price has been going up until here. What we get is it prints what is an engulfing candle, and is also a key reversal candle, if you know what that would be. Okay, namely, after an uptrend, price pushed to a new high, but it closes beneath the low of the previous candle. Okay, it's a big significant shift. They don't happen very often, but when they do, okay, that's what happens. And this is what we're looking at here. Where you're following the standard entry, okay, you'd have been entering here around about $18.99. Okay, your stop loss, okay, above the highs there at $19.61. So we know that our trade risk is $62. Okay, and we've got $62 that between our entry and our stop loss, and that means based on just how we were talking about trading a engulfing candle, is that our target is $18.38, which gives you a 1-to-1 reward to risk ratio. Okay, and that's fine. And actually we can see that the trade actually does, it gets down to around about there. Okay, but alternatively, by looking at the improved entry, let's just clear the drawing, by looking at, if you were to employ an improved entry, well, now remember, okay, your entry is a third of the way back into that candle. So now you enter it, you're short at 1920. Your stop is still at 1961. Okay, so you've now got $41, okay, of trade risk in terms of how far between your entry and your stop loss. But now also what we're looking for is your target is a 261 Fibonacci extension, which is down here, which is actually at we're calling it $1807. All right, $1807, which is just also in front of the 1800 big psychological number. So kind of the same trigger candle has given us two different types of entry. The standard entry has worked; it's worked out nicely, okay, and it has generated a 1-to-1 reward to risk ratio for you. But the improved entry, okay, using the pullback of a third of the way into the candle, okay, with your stop in the same place, well, that has now basically that's generated 2.7 R, okay, not 1-to-1, but 2.7 R from the same trade, okay, from pretty much the same trade, okay. So hopefully, that gives you a little bit of insight. Even just that, that's just the same setup. You can see how a different entry, an improved entry, okay, can actually sort of from the same trade, from the same move, can help you make a big difference in terms of your entry, okay, in terms of the kind of the profitability of that particular trade setup. And that's what we're just trying to get the message across here today with. Here's another example: dollar against the yen, the 4-hour chart, okay, and the engulfing candle. So price is in a nice downtrend, price pulls back, and then basically price prints, okay, a bearish engulfing candle at the end of a pullback in a downtrend. The standard entry, okay, what you would have expected. Standard entry would have had you, entry at like 108.60, okay. So then the bottom of the candle is 108.65. So just you'd have it just a few pips beneath. So we're entries at 108.60. Our stop is just above the highs. Okay, the high is 108.86. So our stop is about, let's say, 108.90. So we're risking 30 pips, and we're looking to trade it down towards the big round number, okay, at around about 108, okay. And that gives us a 2-to-1 reward to risk ratio on our trade using the standard entry. And for many traders, that would be very happy. They would be very happy with that. However, once you're using the improved entry, okay, remember the improved entry is that what we're looking to do is our stop loss is going to be in the same place, but our entry, okay, our entry would be a third of the way back into our engulfing candle at 108.72 rather than at 108.60. Stop loss, as I said, in the same place at 108.90, okay, but now our trade risk, instead of being 30 pips, our trade risk is 18 pips. And, because there's a 4-hour swing, we're looking to go for the 423 target, which is actually just beneath the 108 number. You can see that the actual 423 extension is at 107.97. But so don't be a dick for a tick. Just actually, if it hits the big round number, which as you can see it did at 108, well, that actually generates a 4-to-1 reward to risk ratio. Okay, so same trade, okay, same move, but that was an opportunity for you to generate 4-to-1 as opposed to 2-to-1 on your particular trade. So hopefully that can give you a little bit of an idea, another example of how that can actually change, okay, and can make a big difference to your, to your profitability as a trader. And here's one on the cable on the 4-hour dollar chart, okay, pound against US dollar 4-hour chart. Price was in a downtrend. Price actually double bottoms here, okay? Price double bottoms here and puts in a bullish engulfing candle. It's also a key reversal candle, so we're expecting a bit of a move up. The standard entry, which, and this is the thing, you can see this as kind of a big candle there, okay? Standard entry would be, you'd just be getting in just a little bit above. So your entry is at 137.50, and your stop loss, okay, is beneath the low at kind of 136.65. So our trade risk is 85 pips on the standard entry. And what we're going to look to do is we're going to look to, once say, target a big round number, okay, up here at 140. And actually, that, as you can see for yourself, that trade generates a 2.9 plus 2.9 reward to risk ratio, which is very handsome reward to risk. And as I said, some people would be very happy just to trade that particular way, and I'm not disputing that. But using the improved entry here, using our improved entry, well, now our entry is down here, okay, all right? It's a third of the way back into the candle. So it's an entry of 137.20, stop loss in the same place beneath the lows at 136.65. But now our trade risk is 55 pips rather than 85 pips. And the 423 target, okay, up at 139.91. Well, now actually what that does is that generates a plus 4.9 reward to risk, okay, rather than 2.9. So as I said, same setup, same trade. You can see that the market's made the same move, but by actually having that improved entry of that little pullback into the candle, that makes a big difference, okay, in terms of the overall profitability of the trade. And I hope you can particularly see that. So it's kind of finalize and run away is that few final points is that there is no such thing as perfection. Okay, I've said that many times. There's no such thing as perfection. Sometimes, a trend might be so strong that it actually will never pull back a third into your trigger candle. That happens to everybody, including myself. All right, what can I say? Welcome to trading. Okay. If it doesn't pull back enough because the trend is so strong, well then maybe you might want to go back and watch the webinar that we put up earlier about or last week rather on the FTR setup, because that might actually come in useful as a way and a means to basically to join a strong trend that has actually already moved. So here's a little bit of homework for you to take away, ladies and gentlemen. Okay, just go back through your last few winning trades. Just have a look at the screenshots of your last few winning trades and work out how much additional alpha could you have created using the improved entry. Okay, just go back, look at it. You might be a little surprised for yourself. You might, just looking at trades that you have taken yourself. Okay, just look at that. Just look at how that different and what difference would that have made to your overall equity curve? Because when you see that and how it could change, the trades that you've done, that's when it starts to become a lot more interesting for us. So in conclusion, okay, listen, ladies and gentlemen, it's important for traders to understand trade risk and its relationship with the reward to risk ratios. The smaller your trade risk, the opportunity to achieve a greater R3 helps. And by doing so that way, it gives you ways to explore improving your reward to risk ratios. One way of doing that is by improving your entries, and in particular, the one I've shared today is just using a pullback of a third into your trigger candle as your entry point. And that's what helps nudge the R3 into more favorable territory. And that's going to make a difference to your equity curve over time. But nevertheless, it still requires good trade selection. Okay, that is not going to get you out of a bad choice of trade. It's about making the best of your particular winning trades. So don't forget to join us next time, ladies and gentlemen, okay, where on Wednesday, coming back to join me, where actually what I'm going to talk about is the shift in power from west to east, including the rise of China, slide of the west, Chinese stock markets, and the importance of commodities in that. So come and join me, okay, Wednesday, 28th of April, 2 o'clock London time. Check your inbox for the webinar link or head over to the Admirals site to register for those particular live webinars. So, I hope you've found that kind of particularly useful. I hope that's given you a little bit of food for thought. I was hoping, okay, let's see, I was hoping that basically we would be able to have time to effectively go and have a look at the live charts. But as always, time is against us, ladies and gentlemen. But you might want to have a little look at just have a look at pound against Swiss franc on the 4 hour, have a little look at pound against yen on the 30 minutes from yesterday, and have a look at pound against New Zealand dollar on the daily. And, you might see a couple of setups there that would have triggered very nicely using the kind of third pullback entry into the trade to give you just a little bit of a smarter entry that would help you improve your reward to risk ratios. I hope you found that useful. I hope it's given you some insight. If you're watching this on YouTube, then fantastic. It's great if you're watching on demand. Make sure that you're subscribed to the Admirals channel. Give this a like. If you've got questions about it or thoughts for future sessions, just tap them in there to the comments box. We always really enjoy that. And as always, okay, I wish you the very best of success in your own session. And I look forward to seeing some of you next Wednesday for our next Admirals hot topic webinar. Have a great trading weekend, and I'll speak to you soon. Many thanks.